While Wescoal's full-year headline earnings per share ticked up 7% to 12 cents, revenue climbed 7.3% to 677 million rand. The company's declared a maiden dividend of 3 cents, and joining us now to unpack the numbers is the company's CEO, Andre Boyer. Thanks so much, Andre, for joining us today. Well, as I said, Wescoal delivering a strong set of results for the year ended the 31st of March, and that despite, as you say, quite challenging market conditions in the mining sector. Talk us through the steering you've had to do over the past year.
The results are not stellar, but we consider them solid, as there's been real challenges. Early in our year, we had the labour unrest, which was national. Road freight strikes, couldn't get coal out, huge diesel price increases, which we all know about. Yet our management team managed to contain those, and the Wescoal mining specifically did very well over the time.
Let's talk through how exactly you've managed to get it right, because it's always the how that has to be in focus.
There's two issues. One is cost control, and the second one is volumes. Our volumes are up, and cost controls. There's no other way you can do it in the mining environment. It's a volume-based game.
Well, it's looking at good to the extent that you've managed to declare a maiden dividend that's come in at 3 cents per share. So to an extent speaks to the kind of stability and also the profitability and your cash base moving forward. Talk us through that and just how sustainable
we've had very strong cash flows. We've invested 40 plus million into our own operations, which we've generated in the last 8-9 months. We're projecting strong cash flows going forward. So it's about time the shareholders got a return on the investment. It's been a long time. They've had a struggle in the past. We've had our historical trouble. But now we're out of it, and we really are performing well with strong cash flow.
So payback coming through. Let's break it down division-wise. The mining division, you say, remains buoyant, and that largely due to your supply contracts in place with Eskom. The supply-demand scenario that we're looking at right now?
The demand from Eskom is very high. It will continue to be high. Their long-term contracts are tailing off to 2015, and they need to look to the junior miners more and more.
So their deficit playing well into your hands. Yes. How are you able to cater to that?
Well, we've got to accelerate our expansion. That's the bottom line. We've got to get Elandspruit up and running. We've got to increase our tonnages out of Khanyisa and Ntubani, and we've got to look at other projects.
With what kind of pricing power?
Are you talking Eskom pricing?
That's it, because one assumes that you've got settled supply agreements in place with a player like Eskom.
We're happy with our pricing structures at Eskom. Eskom pricing going forward, I think in the long term, ultimately they'll have to pay a higher price for their coal because of the deterioration or the declining contract base they've got. So that going forward, they're going to have to pay a higher price.
We've got the inland market being quite opaque in terms of pricing and the pricing structures that we're looking at. Talk us through that and just how much of a challenge that is.
The inland market, which is our trading division, it's overtraded. Every man and his dog wants to become a coal trader. They think there's money in it, and it's become an overtraded environment. The primary producers also entered the inland market in the 2009-2010 year, but they targeted the high end of the market. So you have this massive competitive base which never used to be there. So there's also consolidation coming in that area. And
yet we've got the inland coal price still higher than what we're looking at on the global scene.
Yes, it is definitely. Back at mine, there's definitely a premium on the inland market. As compared to the export pricing.
So what's the cause there? Because this is a logistics game, so do we attribute it chiefly to infrastructure?
Shortage of supply.
Shortage of supply, bottom line.
Bottom line. There's got to be a certain tonnage exported, and the mines are battling to keep up with the export tonnages. So the inland market is starved of product. So if you want products in the inland market, you've got to pay a premium to the export price.
Okay, so you mentioned and alluded to the fact that this leaves room for consolidation.
Yes.
Let's talk through how you're playing that game, because we're looking at you holding at this stage an ungeared balance sheet. So that puts you in a pretty strong position to play in that consolidation game.
Quite right. We announced a short while ago a third-party transaction to buy another trading company. It's a solid company. We're looking to acquire it, and we're looking to debt fund it. So our balance sheet will fund that acquisition. It's a form of consolidation. It will give us a higher critical mass, and also better negotiating power.
Let's take a look at operating costs, because you mentioned they increased. You've managed to contain costs to an extent, but we've still seen that operating cost base increase close enough to 20%, and largely because of costs related to bringing in personnel at the top level management. So that emphasizing the kind of investment you're making in skill at the moment.
We have to. There's a dire shortage of skills in the mining business, without a doubt. And with our expansion plans, you look at Eland Spruit coming online in the next 12 months to 18 months, we had to have the skills to be able to do these developments. Mm-hmm. You can make a mistake in mining so easily. So we brought on board skills. They are very good, mature skills, and we have to invest the money.
Mm-hmm. Looking at that investment moving forward, to what extent do you see it extending now beyond South Africa?
Currently, we're not focusing on anywhere but South Africa. Potentially in the future, maybe we look at Southern Africa, the SADC region, but right now we've got no plans to look outside. Our business is built on the domestic market. Our business historically is domestic market, and there's a big tonnage inland. There's 16 million outside of Eskom. There's a 16 million ton market available to the junior miners.
So get it right at home first.
Get it right at home.
In that bid to getting it right at home, you've made significant cash investments into infrastructure. What exactly are we looking at there?
We opened up an underground operation at Khanyisa to extend the life of mine at Khanyisa, and obviously we've developed in Ntubani. The question 6 months ago, 12 months ago, where are we going to get the cash to open in Ntubani? I said, we've got the cash. Couldn't tell them where the cash is coming from, but we've got the cash and we've generated it ourselves. And in Ntubani, we got our water use license in April, and our first coal came out of the ground in June. Mm-hmm. Without any debt, purely self-funded.